It is my pleasure to introduce Harbor Advisors and Chief Investment Officer and Senior Portfolio Manager, Peter Hofstra. Thanks for doing this for us today, Peter.
Oh, my pleasure. Happy to do it.
Peter brings to us over 18 years of experience investing in pretty much global equities with a focus on Canada and the US. And he manages one of our equity mandates in the managed portfolios that we have. And we always appreciate his insight. He's very happy to be doing this for us, and we're glad to have him here answering a lot of the questions that you've sent us. So with that said, Ken,
So I want to thank you as well, Peter, and so we'll jump right into the questions. We'll read these out that we got from our clients and give it a go. So Peter, we like to use the analogy with our clients that this is not a typical recession nor typical job losses. This is more, we feel, a man-made recession where the world leaders said that we're going to turn off the light switch so we can stay home, be safe, and avoid a massive spread of the virus. But eventually, the lights are going to come back on, but in the form most likely of a dimmer switch where it's brighter in some areas and not so bright in others, with the expectations that the lights will eventually come back on. During that period, did you see any examples of investment opportunities that were just yelling out, knowing that we will get out of this period, and what you saw while it was dark as an opportunity?
Yeah, it's a good question. And, one of the things we've said is one of the things that's been unprecedented is the number of times we can use the word unprecedented, right? It's just been, it's been an absolutely incredible experience, 2020, a global pandemic and how we manage it, and such a strange sort of virus and associated symptoms that it seems, the vast majority of the population is probably completely immune to this thing or gets some level of mild symptoms. But there's a percentage that obviously either has pre-existing conditions or the elderly are impacted quite a bit, and they could have easily overwhelmed our health system. So, you go back to March in the early days of this, and that's what really was it about. We didn't know what we were dealing with. We didn't know who was impacted and how. And so the answer was to hit this hard. And that's a great analogy, just like hit the light switch, hit the power button, like full shutdown. And so we figure out what this is. And we did jump. And even our commentary back in March was to say, like, people buy now. If you're going to own stocks, now is the time to buy them. When you look at the long-term charts, and when there's sort of dramatic sell-offs are usually those great opportunities to buy. And it's extremely difficult to pick the bottom. As we know, if you're buying in the fall of 2008, it would have felt horrible in sort of February, March of 2009 when the actual, but a year later, 2 years, 3 years later, you're going, wow, I'm so glad I bought in fall of 2008. So trying to pick the bottom is extremely difficult. So we were fairly aggressive buyers in March. After tipping fairly defensively early in the year, and our sort of thesis coming into the year is we're stuck in a slow growth environment. And that's, in part why interest rates had been so low. Probably staying low for a long time now as we work our way and bring that dimmer switch back up. But we tipped sort of more toward defensive names, utility, telcos, what we were doing. And so as March hit, we really repositioned kind of back to a pro growth, but we're very, very active through the end of the first quarter and into the second quarter in summer. Because with the recovery was something we hadn't necessarily anticipated, we just felt there's some phenomenal businesses on sale. So in Canada, buying sort of the Dollaramas, which are always hard to own, the Constellation Software and a company called CCL Industries, who are great acquirers. So the view being that if there's a lot of distress here, if you have a great balance sheet and part of your business model is to roll in other businesses, you're going to see a world of opportunities. And on the US side in the value portfolio, we're buying things like Johnson & Johnson, right? So we were going into the healthcare space because, healthcare, we knew it had to be part of the solution, but it was selling off with the broader market and the broader risk-off trade. And maybe one thing to note is we're now also running the Alpha portfolio within the Evolution platform. And then there we can do some other things. In other portfolios, we're buying Amazon for the first time. So it's, who is this good for? I mean, well, this is crazy for, restaurants and travel and those things. Home delivery, work from home, all of these platforms are really those trends are being accelerated. And so opportunity to look for lots of things. So we really were. Then when things started to hit, we thought, we may not get prices like this again. Maybe it's not the bottom, but there's some incredible returns here. But really manage the business risk. We weren't going into travel. We weren't buying airlines. We thought there's still too much risk associated with those. Who are the robust companies? We know we're coming out the other side, and we're getting prices that we've not seen in a long time. So yes, we did seize the moment.
Interesting. You bring up Amazon, which has always been a stock that's been the flavor of the years over many years. It didn't make sense but it just because it shows up on your doorstep, it's an amazing thing. So you talked about now that you guys are you looked at Amazon and bought it. What made that decision? Is it because they are a COVID kind of stock and that things are going so massively online? What was it that sort of made that interesting to you guys?
No, and really what we try to do is find all the things we would love to own. And any time we're going to own, call it 30 to 40 stocks, but we want to be calibrated on several hundred. And we have a big quality bias, and we can maybe explore that if it makes sense. But it's like, who are the names we'd love to own? And Amazon, you're right, didn't make a lot of sense because they didn't make money. And if you care about cash flow and all of these things, it didn't add up. But all of a sudden, AWS, their web services business, it's gushing cash. They've been able to turn on between their Prime memberships. All this revenue streams are highly recurring. They've now become a very, very profitable. The cash that's flowing into the business means it's extremely self-funding. So Amazon tipped over to a business we wouldn't have owned to one we would have owned based on its profitability and cash flow profile, but still too expensive. So now here's one we want to own, and it finally got to a price point where it made sense for us. And then as we build our financial models and look forward, we're saying, you know what, any near-term numbers we had were probably conservative. Anything toward e-commerce, everything toward home entertainment, right, with its Prime Video. All these things are being accelerated, as these work from home platforms, which are all going to be hosted. The web services, all these are the great growing areas of the economy. So there's a really chance to finally get the price in a business that had sort of kind of tipped into a universe of where we would love to own it.
Okay, great.
You know what, we had a follow-up question for a little bit later on, but this is a perfect segue into what you were just saying. When we're just talking about style of selection of stocks. So we know that you're predominantly more value style. And, so that was one of the questions as well, value style versus growth style. So the more patient value approach that you've been using in recent years, and especially this year, hasn't been as rewarding as the growth and momentum style of investing. Now, do you anticipate this to reverse and for your patience to be rewarded sooner than later? Or do you change your approach when these trends are not fully favorable with your style and approach? So I think you led to a little bit of that with names like Amazon that prior you wouldn't even look at, but now, representing a pretty good price point for you. So maybe if you could just share a little bit of thought on that, please.
Yeah, and maybe it's maybe an interesting answer. It's a good question. And we've been engaged sort of coming up on 3.5 years within the Evolution platform, certainly starting with the value. And the 18 years experience you referenced to is, I'm older than the 18 years experience would indicate because I spent some time in another industry first, and that was in technology. And so coming to this industry, I really came in as a newbie asking a lot of questions, like, why do you do that? Why do you think about it that way? Why are these the categories? And value and growth kind of threw me off because they're very different things. If you're shopping for a car, you might shop for, do you want certain horsepower? Do you want mileage? Or there's characteristics. And then you might take a step back and say, okay, now I know what I want. How do I get the best deal? So sort of those characteristics and price are very different dynamics. And growth is kind of a characteristic of a business. Is it growing? Is it growing revenue? Is it growing earnings? How is it doing it? Value is kind of relates to what you pay for it. Right, and so to say, a great deal on a Corolla is not the same price point as a great deal on a Mercedes or something. And so we've always kind of thought about it differently and not felt constrained to say, we're a value or we're a growth investor. And I think at the extreme, what people are talking about is value is often that deep value. Something's trading, less than the value of the assets. That kind of cigar butt traditional notion that Warren Buffett at one time practiced and sort of evolved away from. And then growth has kind of been, we don't care what we pay. This thing is going to be so big and so huge, it doesn't matter what you pay today, it's going to be so much bigger in the future. And frankly, we don't do either one of those and have never. That's always been, we're value buyers because we care a lot about what we pay. But again, a great deal on a Mercedes is a great deal, even though it's a very different price than a bad deal on a Corolla would be at a much lower price point. And we love businesses that can grow. Like if a business has a big moat where they're generating, say, 20, 30% return on capital, but there's opportunity to take all of that capital and reinvest it and earn the same rate, and they can compound at 30%, we love those businesses. What we really want them to do is be self-funding, right? So they're generating, this is why the Amazon moved into this ownable bucket. So they're generating the cash off these powerful business models, but that they can reinvest them. And this world of zero rates is a lot because economic growth in the developed world is very slow. So growth becomes very valuable. So we kind of find ourselves, we call it sort of the quality end of value and the value end of growth. right? So we don't play at the outliers. We kind of play in that sweet spot. But you know, a Constellation Software is a fairly rapidly growing business, but all self-funding. But they can grow at 30% a year. So we like those types of opportunities. And same with that's, you know, Amazon's moved into this bucket. Microsoft has growth ahead of it. And so we don't mind owning those business, but we are sensitive to valuation. We will sell them when we think, you know what, we bought our Mercedes for X. It's now trading at 1.5X. You know what, take it. I can buy another one for brand new and have a lot of cash left over. So it's a value framework we would bring to kind of a quality universe. And we think that's the best way to get through even environments like this, where that quality bias is so important, to have businesses that can skate through an environment like this. So hopefully that clarifies it. So it might be a different way of thinking about that value growth paradigm.
That's great answer, and I guess it's that flexibility that is important as well, the way you're sort of playing that sweet spot. Thanks for that.
Exactly, Ken, if you don't mind. That's why, you know, Amazon was not a great name for a value portfolio.
Right.
But as you move into the alpha, it can start to make sense. Where there, it's just whatever we can do to make money, let's try to make money and make sure those portfolios are a complement to each other. So we do respect kind of what the product is intended to be, because that's serving a role in people's portfolios. So we are a lot more cautious with that value mandate, say, than we might be with the alpha mandate. So we certainly respect what we're here to do.
Okay, excellent. Next question. With the second wave of COVID-19 clearly underway, what do we expect that over next, I guess, short term, next number of months, we're going to see, we're guessing, a fair bit of market volatility. So what would be your strategy, given the fact that we might be seeing some volatility over the next while, if any, to sort of help offset that volatility?
Yeah, and it's all great questions. So, you know, we've always said kind of volatility is the pain you have to endure to get the gain out of stocks. So you can't eliminate volatility, or you will give up that opportunity to generate long-term returns. Now, having said all that, we do look at the longer trend. So as we move through the summer and into August, July and August were unbelievable market returns. And that's kind of what made us more cautious. Because our view, this is an artificial economy, right? It's being supported by governments and central banks. At some point, that's going to have to tip back to the real economy to support employment and other things. And that could be a painful transition. Yet the market is right back where it was in early 2020. Now, not quite, because a lot of bifurcation in the market, as we know, only there's a few stocks that are up a lot and a lot of stocks that are not up. But overall, that just sort of made our tone more cautious. So we had kind of moved defensive before the volatility really kicked in. But as it comes in, we tend to be, call it adding beta, almost adding volatility as it occurs. That's the opportunity for us. And again, think of that Amazon. We're buying it when that price collapses, or the Johnson & Johnson, or the Dollarama. And then, you know, you're right, the second wave is here, and look at this, the US election, right? I mean, it's going to be volatile. However many days we have left to the election, it's certainly going to be more volatile, and then we're more back on to vaccines and treatments and stimulus plans and other things. And so it really is, what do you want to do when you're served up a bunch of opportunities, and be calibrated for that? Because at a time to go into industrials and more cyclical names, and we would say, you know what, not yet. Let's focus on those quality names that are kind of benefiting from some of these trends that are being accelerated by the fact that COVID is existence. I mean, work from home and hybrid models have been around. They're just being accelerated by this sort of environment. So we're not getting super pro economic growth yet, but we'll use that volatility to kind of tip out of defensive names and into more pro growth names. And in the near term, that can add a bit of volatility, but we think that's ultimately what generates the longer term returns. So that would be our encouragement. We got to stomach a little bit of volatility to really get the benefit out of the stock market. Just do it very prudently.
I like the way you said that. Just like working out with the weights, no pain, no gain.
No pain, no gain. I'm sorry,
Yeah.
that's the nature of the market. The volatility is the pain. You need to endure to get the gain.
Absolutely. You also just mentioned a little bit about the election, and actually that was our next question about the US election. So there's a growing sentiment that basically markets would not respond favorably to a Biden win and his proposed increased tax hikes. So I guess the question is, would you reposition the portfolio if it's expected that either one of the two parties will not, you know, basically line up well with market expectations and investor returns? And, you know, how do you make those adjustments, and what kind of adjustments? As an example, you've alluded to a couple of them in the prior question, so maybe if you could just elaborate a little bit on that, if that's okay.
Oh, absolutely. And it's, you know, it's again, very interesting election. What you see, if you look historically, all the volatility tends to come before the election. And then once the election's done, the markets tend to do extremely well. And it doesn't matter who wins. Our broader suspicion is that's going to likely be the case again. When we talk to business managers, again, because we're concentrated, we spend a lot of time interviewing management. And the tariff wars sort of throughout the Trump administration really brought the point home that businesses just need certainty. And if you're going to tariff anything, just like do it and tell us what it is so we can plan, so we know how much capital, we know how to price things, right? We know where to source them from. Just set the rules and leave them alone, please. And it's similar with taxes, like just set it and leave it, right? And so, that we're running huge deficits and those sorts of things, and potentially we're going to have to pay some of this back one day. And so to us, it matters less who wins in that broader context. We do assume if Biden wins, corporate taxes are likely to go higher. And so then you can look at, well, who's really domestically centric in the U.S.? So maybe the U.S. banks would get hit harder than a lot more than an Apple might, or a Johnson & Johnson might, who are truly global operators and are taxed in jurisdictions all around the world. So we think about those things, but even if you take a bank, which is entirely U.S., it's probably a 6 or 7% impact to EPS if he goes to the full 28% tax rate from the current 21. So these impacts tend to be a lot less to the market than sort of the pre-election hype would indicate. So then we would get more specific. And so then you can get into things like healthcare, right? So does Obamacare get abolished if Trump wins and we have another 4 years and he's tipped the Supreme Court toward the conservatives? So if Biden wins, you're more likely to see that healthcare spending and all those who didn't have health insurance continue with it. So there's sort of sub-pockets. And of course, you think about climate-related infrastructure. There's probably a lot more investment there, probably far less in fossil fuels, right? A Trump administration would be more supportive of the fossil fuel industry. So we do drill down a little bit and say, what are the sectors that we want to be careful with, and what are the ones we may want to gain exposure to? And again, if Biden wins, where do we potentially want to add? And it would probably really be around that sort of climate-related infrastructure type investments, which should have a fairly long tail to them under his administration.
Excellent. Interesting insight. Thank you.
I guess it's fair to say that as a portfolio manager, you're not going to guess and think one's going to win or the other one's going to win, whether it's Biden or whether it's Trump, and make decisions before. You're going to see how the cards play out and then make your decisions based on who the new leader is, I guess. Yeah,
we learned our lesson last time. It seemed we had a lock with Hillary, and I don't know if you stayed up and watched the election, but at the time, the futures were just obliterated as it looked like Trump was going to win. But I think by the time the markets opened here, I think we were down 0.25% or something like that.
Yeah.
So we thought this world of opportunity, but that's a classic one. Look at pre-election, even election night, to what happens after the election. And again, there's a lot of administrative momentum, certainly within the U.S., as you're finding Trump has probably been the most radical president we've certainly seen in our lifetime. And there's only so much you can do, as much as he's pulled every lever he can to kind of function independently. So there's a lot of administrative inertia there to overcome. So things don't necessarily change as rapidly. And you're right, it's more thinking that, where do the industries and companies that it doesn't matter who wins. Let's focus on those. So as we look through the volatility, that's where we focus. Yeah, we don't say, let's count on a Biden win, but it's also Biden doesn't win. What should we be avoiding? And just kind of avoid those areas for now, let the dust settle, and work our way back in when prices indicate we should.
Good.
Great. Keeping it in the same flavor when it comes to governments. So government stimulus packages and intervention, which were so important. On one hand, families, businesses, markets get the needed stability in the short term, but we know that there's a cost in the long term, potentially in the form of increased taxes, payday at some point. So can governments afford to continue helping like this? There's still talk about there is a need for help. If not, where does it leave certain industries like airlines, restaurants, tourism, that kind of stuff?
Yeah, and this is, I would say, probably the most fascinating, of the unprecedented things. The one that's really going to be interesting to digest is the way that support has been brought to the populace. In theory, the big precedent setter here was that as we had a recession, forget the cause, government said, no, we're not going to have it. We'll just put money in everybody's bank accounts and you can keep spending. And for those that remember the great financial crisis, Ben Bernanke called that helicopter money, right? He was asked if the banking system doesn't work, because normally you cut interest rates and hopefully people want to borrow. He's asked, well, what if no one wants to borrow? So we just start dropping money off at people's houses. Well, guess what? We just started dropping money off at people's houses. So we'll see. That means we don't ever have to have a recession again, right? Your point at the beginning, this was man-made. So governments felt they had to respond this way, but that's a very interesting dynamic. And so you're right, that's meant tremendous debt accumulation through this. I think what it really means, number one, is interest rates cannot go up, right? So this is all comes down to affordability. And one thing we've said is if interest rates are zero and you only have to cover your cost of interest, how much debt can you carry, right? In theory, it's infinite. Show us a developed economy that was able to run their debt level back down on a consistent basis, right, after it was run up. Doesn't exist, right? And so it's a really new paradigm to think about. And if we're at ultra low interest rates, where that really is very supportive of the stock market, but you think about how fragile that becomes, the opportunity to raise rates just doesn't exist. And whether that's consumers, whether that's governments, right, that carrying costs are what is so important. And so that's the piece to monitor. So then you keep peeling that back and say, well, what could force that? Well, it's inflation. So what did you see, Jerome Powell do in the US? He said, we're going to let inflation run and leave rates low. And that's the only way we kind of get out of this. Inflation pays off debt, right? So whatever we borrow today, that's a fixed number. But if inflation means our incomes and tax revenue and everything grows, that's what helps. That debt load diminishes against our income and future revenue base. And so what you're seeing central banks are going to do, we have to keep the affordability effective, so low rates, and we have to let inflation run. So they're still desperate to get some inflation, and they're going to let it run above 2%, because that's kind of the only way out of it. To tax your population, there's certainly cost to that. In Canada, we feel our tax rate. Are you willing to pay more taxes? Right? Then you start to crimp consumer spending, and tax can create a negative feedback. And so, and so in the US, there's an opportunity to maybe tax corporations or the ultra wealthy and those sorts of things. So I think you'll see some tax adjustments, but I think that's the big one to watch is, does inflation come back? That's key to keeping the debt managed, but it's also important that if it starts to run 4 and 5 and it's going to force rates higher, that's when we really need to get concerned about the economy and obviously the stock market. So those are some dynamics to watch closely. In the near term, it looks like rates are not going anywhere. But that's I would say, the fragile dynamic we really need to keep an eye on. Because again, if the rates have been negative, think of how much debt you get paid to issue debt. And you show up and say, I want to buy a house and I want to get a mortgage. What's it going to cost me? And they say, how about we pay you $1,000 a month to take on $1 million mortgage, right? I mean, what do you say, right? And so how much debt can you carry if they're paying you to take debt? So it is a real interesting paradigm, but I think that inflation element is a critical one to watch, because that can really sort of shift the tide.
Good. Next question, more on basically what's on your radar screen, I guess. So when you have well-respected players like Warren Buffett buying and selling significant positions, more notably his recent sell-off earlier this year in Canadian-based RBI, which is Restaurant Brands International. How much attention or influence does this have on a money manager like yourself? Like, how much do you pay attention to this, and knowing that he typically has larger positions and can sway the markets, at least in the short term, with his entries and sort of getting out of the certain positions that way?
Yeah, we do look at that generally. So if a position is, we own or are interested in is selling off, it's really, we do like to try to understand why. And it's always, are we missing something? Is there information that, someone else has that we should have? Or is it somebody repositioning a portfolio? And that can be, large asset managers, or certainly someone like a Warren Buffett. And then if he's making a move, it's, what's the opportunity to understand why? Is he just repositioning a portfolio? He's made tremendous gains because he was an early investor with 3G and this type of thing, and he's just reconciling things, so it's not a statement on the company? Or is it a statement on the company? And what you find from all of that, we do not follow the individual decisions of someone like a Warren Buffett. We read him, we try to understand and learn so much from, a lifestyle of investing over many, many decades. But, he was buying airlines and turned around and sold airlines. We weren't following him into airline stocks. And it's just kind of the Venn diagram of no investor bats 1,000. So there's no investor you can, if you do pick one of their moves, you're guaranteed it's going to work out. If you're going to get Warren Buffett's returns, you kind of have to do everything that Warren Buffett is doing. And that's not what we do. Yeah. So we do watch the news flow. We do like to know what is driving any volatility in individual stocks. There's smart minds out there, and we respect that there are. So when we always want to stay humble and question ourselves and our thesis on a name. And so that's why we would not follow a specific move like that with the Warren Buffett. We were owning technology stocks before Warren Buffett was, in our favor, right? And he now loves them. And I think to his credit, he's clearly empowering his next generation of investors. and he sort of highlighted some of the individuals, but you're seeing a lot more investment in technology. He just took a huge bet on Japanese trading companies, right? And so he's really doing some interesting things. So I think he's really got his lieutenants fully empowered to do a bunch of things. So it's another dynamic. It may not just be Warren Buffett's mind you're seeing expressed, but Wells Fargo is a name we haven't participated in. So as much as there's a world of respect, it doesn't necessarily pay to think every single move he makes is going to be a prudent one.
Makes sense. Makes a lot of sense. Maybe we can just sneak one more question in if you have time.
Yeah.
I guess here's one that we got. Which sectors are most likely to profit from the current situation? It's obviously a new world, and there's going to be a lot of fallout, but also there's going to be a bunch of new business that are developed and other opportunities. So will pharma be an interesting area because of the vaccines? Is it infrastructure to keep people working? Is it green energy projects? Sort of, what do you see with this new world where there's opportunities that have presented themselves that would not have been there pre-COVID?
Yeah, and this is, again, would be a great conversation for everyone. This is really a study in human nature, right? So it's, what are the things we're doing now that are going to stick and what's going to unwind? Are we all going to decide, you know what, I don't miss travel. I'm never going to travel again. Are we all like, I can't wait to get travel back into my life? And we can guess on a lot of these things, but a lot of these things, you know what, we kind of need to wait to see how this unfolds. So within that, the healthcare question's a good one. I think reputationally, this is good for healthcare, but the economics not specifically. So again, the rest of the developed world, we've kind of nationalized healthcare, made it a common good, all except for the US. But if now you're a healthcare company that's developed a vaccine, you're not really going to want to charge premium prices for that vaccine and see that only the rich can get it. So either you're going to price it extremely effectively or donate it, or the government's going to be the buyer, and then you're looking like all the nationalized healthcare programs around the world where there's a big single buyer that's going to get a tremendous price. So the vaccine in and of itself, we don't think is going to be a big economic benefit to any provider of a vaccine. But what it might do is say, you know what, we need this healthcare sector. We need that R&D. We need these companies to be profitable because, there could be a future pandemic, and we need a multitude of enterprises that can participate in finding a solution. So that's why, we're more looking at the testing places, right? It's kind of the picks and shovel of the healthcare industry rather than drug discovery. Again, we've talked on some of the things, certainly e-commerce, there's trends that are accelerating, and home delivery outside of just the Amazon. I mean, how many are getting groceries delivered now, right? So you're seeing a number of these, grocery delivery firms either going public or competing for that mind share. Are those viable businesses? So there's interesting dynamics there. And then is there a time to go back into things like travel, and whether, we've owned a bookings.com because we think travel within Europe is really where it's centric, probably comes back before, broader global air travel does. So we haven't bought an airline, but at some point does it start to make sense to look at those? So we've really divided our world up. We usually bucket things by here's the elite names and the quality cyclicals. We've said in this world, it's a new paradigm. Who benefits? Who's hurt? And if things come back, who do we think starts to benefit? And in what price points do we start to participate in those? Because we're really going to benefit when the economy reopens. But it hopes it gives you a feel. It really is peeling back into the layers within healthcare, within technology, Microsoft with their Teams platform. We think infrastructure is a great area. That's really when we've empowered our team through this round of volatility, that's spending on energy conservation, renewable energy, energy storage. Those are all going to be critical investments going forward. Electrification of transportation, enhancing of the grid. Those are going to be key areas, regardless of how long it takes to come out of COVID. So that's kind of where we're really focusing our attention right now.
That's fantastic. I think that's pretty much all that we had. Right, Ken? In terms of questions?
In respect of time, we probably can keep going another few hours easily. I know I can, but respecting your time, we really appreciate this, Peter, very, very much.
Yeah, we appreciate it very much, and I'm sure our clients appreciate it as well.
Oh, no, happy to do it. I hope it's useful to you and your clients, and yeah, it's an incredibly interesting time. So we're absolutely here and available, and happy to talk through any concerns as they come up.
I'll leave it with this. I love analogies, and I love the analogy of the helicopter just dropping money. We're just going to drop money. It's almost like the financial stork, right? Instead of dropping babies, the financial stork comes by, just drops money on everyone.
But think about that. That's incredible. I mean, it really sets a precedent that do we have to have another recession, or do we just drop money in people's bank accounts to keep them safe? It'll be really interesting to see what the next cycle comes through and what the response is. But yeah, a lot of interesting dynamics this year for sure.
Great. Well, we thank you very much.
Thanks again, Peter.
Yeah, and may the forces be with you.